Professor Sackcamp here. We're going to do a video here on notes receivable. We're going to walk through how to do the accounting and learn how to calculate interest appropriately. So here on September 1st, Adam's Coffee Shop sells $1,000 worth of coffee makers to Joe's Joe Depot in exchange for a 6-month, 5% note with interest due at maturity. Adam's Coffee Shop prepares financial statements quarterly on March 31st, June 30th, September 30th, and December 31st. So first things off, we need to talk about notes receivable. We've learned about accounts receivable, and notes receivable aren't all that different in terms of the fact that we are owed money by people. But when we talk about notes receivable, it's different than accounts receivable in that we are going to charge the person or entity that owes us money interest. Notes receivable typically are for longer periods of time than accounts receivable, but they don't have to be. So here we have September 1st. We are going to sell some coffee makers to Joe's Joe Depot in exchange for a note. They have 6 months to pay us. We see our 6-month time frame here. They have 6 months to pay us. It is a 5% note, which means we're charging 5% interest. And the interest is due at maturity. So we talk about maturity, we're talking about the time period when the note or the amount of money is due back to us. We have information here on when Adam's Coffee Shop prepares financial statements because we're going to have to record some accruals of interest in order to keep the accounting correct. So first of all, first things first. On September 1st, what do we do? So here's our date, September 1st. What are we going to record in our books? Well, we have a note receivable. Okay, the note receivable is for $1,000. That is how much the coffee makers that we are selling are worth. And so we have notes receivable and sales revenue. 1,000. Now we'd also want to put in the cost of goods sold and the inventory if we were doing a perpetual system, but I don't have information for that in this example, so it's okay, we skip that part. Now, the next thing that happens, the next date that we care about is what? The next date we care about is September 30th, because on September 30th, we are preparing financial statements for the end of the quarter. Now, on September 30th, we're not going to get any money. Okay, this note is for 6 months, which means at the end of 6 months is when we're going to get the money. But we need to record something here because we are charging interest for this $1,000 and we are owed money. We have earned the interest. And what do we know about revenue recognition? Revenue is to be recognized when it is earned. So the question becomes, how much revenue did we earn? This is where we need to learn and apply the interest formula. Now, I like to call this interest formula the I-party formula. Interest equals principal times rate times time. I-party. Now, that's not really what it stands for, but it might help you remember what to do. Principal is the original amount of the note, so our $1,000. The rate here is 5%, and the time. Here is where we have to understand interest rates. Unless a problem tells you otherwise, an interest rate is an annual rate, which means the 5% in this problem is what we are charging for a year, 5% per year. Now, we have not loaned this, or we have not been owed this money for a whole year, so the time portion needs to take into account how many months we have been owed. And so in this case, only 1 month has gone by. So I'm going to take 1 out of 12 months for my time fraction. Now, if I do this, I should get $7.50. That is how much the customer, Joe's Joe Depot, owes me for interest after this 1 month. What do I record? Well, I need to record the fact that he owes me interest. So I'm going to record interest receivable. Okay, interest receivable. If you can spell. Interest receivable will be for $7.50. Now, what am I going to credit? Well, as I said before, I am charging interest on this transaction, and so I have earned interest revenue. $7.50. So, after the 1 month has gone by, I have to prepare my financial statements, and if I don't have my interest receivable on there or my interest revenue on there, my financial statements are not going to be correct. After September 30th, what's the next date that I care about? The next date I care about will be December 31st. December 31st is the end of the year, but it's also the end of the quarter, and so I'm going to be putting together financial statements again. Once again, I'm not going to get any money here. I'm not going to get paid until the end of this time period of 6 months. But I do need to record the fact that I've earned revenue and that the customer owes me interest. So I need to do another interest calculation. $1,000, 5%. How many months have gone by since my last record of interest? Well, September was my last entry, so I have October, November, and December. So I have 3 months out of 12. And if I record 3 months out of 12, then I should get $22.50. Now, I also could just take my monthly amount that we calculated here to begin with, since it was 1 month. And we know that my interest is $7.50 monthly. So I could just take that times 3. That would work too. Multiple ways you could come about it. But on December 31st, I'm going to record again interest receivable, in this case for $22.50, and interest revenue for $22.50. I've earned the interest, and the customer owes me the interest. Now, after December 31st, what's the next date that I care about? Well, the next date I care about will be February 28th, because that is when the note will be due. If the note was for 6 months, so all of September, all of October, all of November, all of December, all of January, and all of February, that's 6 months. And so on February 28th, the customer owes me the money. So my journal entry will look like this. I'm going to debit cash. We'll figure out how much in a minute, because the customer is going to pay me what they owe me. I'm going to get rid of any interest receivable that I may have, because if they pay me, right, they're not going to owe me any money for this any longer. And since time has gone by between the 31st of December and the 28th of February, I have earned some additional interest revenue. So I've got to figure out what these 3 items are. My cash. How much money are they going to pay me? Well, if they owe me $1,000 and I'm charging 5% interest, and this has been 6 whole months, how much money do they owe me? Well, for interest, they owe me $45 in interest. And so I'm going to get $1,045 in cash. How much have I accounted for already as interest receivable? How much do I have in my interest receivable account? Well, I have $30 in interest receivable, so I can get rid of $30 from my interest receivable. Lastly, how much revenue have I earned over these last couple of months? Well, I would take 1,000 times 5% times 2 out of 12. January and February are the remaining months that I haven't accounted for. So if I do that, I will get $15. Well, we know it's $750 monthly. So $750 times 2, right, is $15. And so my interest revenue for January and February is 15. So that's how I would record the transactions for this note. I have to record my accrual of interest, September and December, right? Those are my accrual entries. And then I can record the cash that comes in when the maturity date of February 28th comes. Let's look at another example. Okay, Adam's Coffee Shop here, again, still August 1st, loans $500 to an employee for 6 months. For 3 months at 3% interest payable at maturity. Adam's Coffee Shop prepares financial statements, same, March 31st, June 30th, September 30th, December 31st. So if I'm only going to record interest accruals quarterly, right, when I have to put statements together, then what entries am I going to have to record? Now, I could record those interest accruals monthly, and that would be perfectly fine as well, but I'm just doing it quarterly to reduce the amount of entries that we have to make. So August 1st, we loaned $500 to an employee for 3 months. So when are they going to pay us back? Well, they get the money August 1st, so all of August, all of September, all of October. So August, September, October. At the end of October, they should give us the money back. And so what do we record on the day we give them the money? August 1st, we record a note receivable of $500. And we are going to credit cash of $500. We gave them cash, and they owe us money. Then, the next date that we care about will be September 30th. That is a financial statement date. That is a adjusting entry date for us in this scenario. So we need to know how much interest do they owe us. So the interest is going to be equal to the principal of $500, the rate of 3%, and the time. In this case, we have 2 months out of 12. We have August and September. And so how much does our employee owe us for interest? They owe us $2.50. So what do I record? I record the fact that they owe me interest, so interest receivable, $2.50, and that I've earned interest, so interest revenue, $2.50. Once September 30th goes by, the next date I care about is October 31st, because that's when they're going to pay me back. So again, I'm going to get cash. I'm going to get rid of whatever receivable I have, and I'm going to record whatever additional revenue I need to record. So if they have my money for 3 months out of 12, how much do they owe me? They owe me $3.75. So I'm going to get back $503.75. They have to pay me the $500 they owe me, plus the interest of $3.75. My interest receivable has $250 in it. And my 1 month of interest, 500 times 3% times 1 out of 12, is $1.25. Therefore, I would record revenue for that 1 month of October, $1.25. So when we do note receivable transactions, we have to know how to calculate interest. To record our interest accruals when they come about, and to record the payments when they come back to us.